Hi and a very good day to Ms. Lim Tan Chin. I'm Aina Batrisha from Group 9. So today we will be presenting on corporate tax planning strategies for Malaysia's small and medium enterprise companies, where we have conducted a case study on Vista Packaging Solutions Sendirian Berhad. So firstly, I would like to introduce our group members. So we have Adriana Kaisara as our group leader. Then me, I'm Aina Batrisha, Mahasin Fazlina, Nur Shahira Aina, and Sarah Balkis. Okay, now I will briefly introduce the background of Vista Packaging Solutions Sendirian Berhad. So Vista is a Malaysian manufacturing small and medium enterprise company that was established back in 2012 and is based in Shah Alam, Selangor. So the company specializes in producing sustainable packaging products, including biodegradable food containers, recyclable packaging materials, and also eco-friendly industrial packaging. Its customers include local food manufacturers and retailers, as well as overseas clients in Singapore and also Australia. So currently, Vista employs about 80 workers and records an average annual revenue of 15 million. Due to increasing demand for environmentally friendly packaging and stricter environmental regulations, the company has experienced steady growth. So, in order to support this expansion, Vista has invested heavily in advanced machinery and green technology, which makes effective tax planning more important for managing costs and also to improve cash flow. Okay, next, moving on to the problem statements, several tax issues were identified as Vista Packaging Solutions expanded its business operations. Firstly, the company did not fully utilize available tax incentives and capital allowances, even though it made significant investments in machinery and also factory building. Then, weaknesses in sales and service tax or SST compliance caused export sales to be incorrectly treated as taxable, leading to SST overpayment and cash flow inefficiencies. In addition, the company was uncertain about the deductibility of interest expenses under Malaysia's earnings stripping rules due to heavy reliance on debt financing. Lastly, there was confusion regarding the tax treatment of foreign sourced income, which resulted in conservative reporting and higher tax payments. These issues collectively increased Vista's tax burden and exposed the company to potential compliance risks.
For tax incentive, the company did not apply for investment tax allowance, despite investing in green manufacturing machinery. With capital expenditure of 5 million ringgit, the company qualifies for 60% ITA amounting to 3 million ringgit. ITA allows approved manufacturing companies to offset statutory income. After applying ITA, tax payable decreased from 1,152,000 ringgit to 432,000 ringgit, generating a tax saving of 720,000 ringgit. However, ITA may be withdrawn if approval conditions are not met. For capital allowance, Vista failed to classify its assets correctly and did not claim capital allowances, which resulted in overstated chargeable income and excessive tax paid. With total assets of 9 million ringgit, unclaimed capital allowances amounted to 1.94 million ringgit. Under Schedule 3 of the ITA 1967, capital allowances are claimable on building and machineries. After applying the capital allowance, tax payable reduced from 1,152,000 ringgit to 686,400 ringgit, resulting in a tax saving of 465,600 ringgit. However, incorrect claims may lead to penalties of up to 100%.
Hi, I'm Mahasin. So let's continue with sales and service tax. Currently, Vista is overpaying sales tax because we are incorrectly applying a 10% tax of our exports to Singapore and Australia. Under the Sales Tax Act 2018, this export should be zero rated, meaning we should pay nothing on that 4 million in revenue. By correcting this classification, we immediately save 400,000 in cash flow. To sustain this, we are implementing a new internal framework to flag export automatically and ensuring that our K2 customs forms are perfectly organized. This ensures we are audit ready for the Royal Malaysian Customs Department while staying competitive in the global market. Let's move on to the interest restriction. Moving to interest expenses, Vista uses significant debt to finance our heavy machinery, but we must comply with Section 140C, known as the Earnings Stripping Rules, which is called as ESR. This law caps our interest tax deduction at 20% of our tax EBITDA. During our review, we identified 300,000 in interest that lack sufficient documentation to pass the wholly and exclusively test. By voluntarily disallowing this amount, our tax payable increased by 72,000, but this is a vital protective measure. It eliminates the risk of 100% penalty under Section 113, bracket 2, if the IRBM were to find these errors during a future audit. Proper documentation of our financing is now our top priority. Finally, we look at our foreign source income. Initially, we treated our Australian dividends and Singaporean export income as a fully taxable in Malaysia. However, under the 2022 exemption orders, this income is actually exempt if it has been taxed in the country of origin and remitted through proper banking channels. By correctly applying this exemption, we reduce our chargeable income by over 1.5 million ringgit Malaysia, which resulting in a direct tax saving of nearly 370,000 ringgit. To maintain this benefit, we simply need to ensure we meet the economic substance requirements by keeping our operation and staffing in Malaysia well documented. This brings our total tax strategy to a highly efficient and compliant level.
Everyone, I'm Shahira Aina, and I will explain the recommendation of tax incentives. The key issue here is that the company did not fully utilize available manufacturing tax incentive even though it met the eligibility criteria. Specifically, incentives such as the Investment Tax Allowance or ITA were not applied for. As a result, the company ended up paying a much higher effective tax rate than necessary. This situation often happens because management is unfamiliar with the application process or is unaware that approval must be obtained through MIDA before the incentive can be claimed. Without a proper planning, valuable tax savings are lost. To address this, we recommend that the company actively applies for the investment tax allowance through the Malaysian Investment Development Authority. At the same time, future capital investment should be aligned with the condition stated in the incentive approval. The expected impact of this strategy is a significant reduction in chargeable income and corporate tax payable. This also improves cash flow and allows the company to reinvest more funds into sustainable production and business expansion. Or capital allowance. The main issue is that the company did not fully optimize its capital allowance claim on plant and machinery used in manufacturing. Although substantial investment were made in production equipment, these assets were not properly reviewed or classified for tax purpose. As a result, allowable deduction were underclaimed. Capital allowance are important because they allow company to deduct qualifying capital expenditure from taxable income over time. For manufacturing companies, machinery and equipment usually qualify for both initial and annual allowance under the Income Tax Act 1967. So the recommendation is for the company to conduct a detailed review of its fixed asset register to identify all qualifying plant and machinery. By doing so, the company can correctly claim initial and annual allowances in the year of assessment. The expected impact is a reduction in taxable income and corporate tax payable. This improves cash flow, strengthens financial performance, and ensures that the company fully benefits from tax reliefs intended to support manufacturing activities.
Moving on to our third area of recommendation, sales and service tax or SST. The key issue, our analysis found that Vista Packaging Solution incorrectly treated their export sales as taxable. Because the management treated this export the same as local sales, the company ended up overpaying SST, which negatively impacted their cash flow efficiency. For recommendation, to fix this, the company needs to strengthen its SST compliance. They must clearly differentiate between taxable local sales, which attract the 10% rates, and zero-rated export sales. Crucially, this isn't just about labeling. All export sales must be supported by complete export documentation to prove that they are zero rated. We also recommend regular staff training to prevent this classification error from happening again. For the expected impact, by implementing this control, Vista will prevent unnecessary tax exposure and avoid the penalty associated with the reporting errors, and this ensures the company stop leaking cash through overpayment. Next, we'll look at interest restriction, specifically regarding the company debt financing. For the key issue, we identified that Vista claimed full interest deductions on your loans without evaluating whether they complied with the earnings stripping rules or ESR. This is a risky approach that exposes the company to potential disallowance and penalty from the tax authority. For recommendation, we recommend that Vista perform an annual ESR assessment. This calculation ensures that their interest deductions stay within the allowable limit. Furthermore, they must ensure all interest expenses are supported by proper documentation to meet the strict deductible requirement. For the expected impact is that the impact here is about the risk management. As studies show, the interest limitation rule increased borrowing costs for leveraged firm, and by ensuring compliance here, Vista reduce its tax risk and prevent unexpected spike in tax liability due to disallowance interest. Finally, let's address foreign resource income. The key issue, due to uncertainty regarding the Malaysia tax rules on foreign income, Vista adopted an overly conservative approach and treated exempt foreign resource income as fully taxable. This led to a direct overpayment of a corporate tax. Our recommendation is to establish a clear internal system to identify and record foreign source income and dividends separately. The company must maintain records proving that this income qualifies for tax exemption among the remittance to Malaysia. For the expected impact, this will prevent overtaxation and ensure Vista take advantage of the exemption available to them. It also strengthens their cross-border tax control, reducing exposure to compliance risks. That concludes our specific recommendation. Thank you.
To wrap up, this case study shows that although Vista Packaging Solutions Sdn Bhd has achieved strong operational performance, its tax management practices have not developed at the same pace. The findings has highlighted that ineffective tax planning led to missed incentives, overstated taxable income, and unnecessary tax payments. By properly applying Malaysian tax laws relating to tax incentives, capital allowances, SST, interest restrictions, and foreign source income exemptions, the company can significantly improve its tax efficiency and cash flow. Overall, this study has emphasized that tax planning should be viewed as a strategic tool rather than just a compliance requirement. Proactive and informed tax planning is essential for SMEs like Vista to support sustainable growth, maintain compliance, and achieve long-term financial stability. So that's all from our group. Thank you.